Hello everyone and welcome to a new video. In today's video we'll be discussing order blocks and we'll also be discussing the 4 golden rules to identify a valid order block. So let's get into the video. So what exactly are order blocks? Order blocks, also referred to as demand and supply, are institutional candles that are an accumulation of a significant amount of institutional positions, right? And the order blocks, they have significant high volume and they become points of interest for large institutional players once price tests these order blocks, as again they have accumulated a large sum of their positions at this zone, and they also look to lay off the majority of their positions once price tests these zones. Hence, we see significant market movement occurring once price tests these order blocks. So the first type of order block that we have are demand zones. Now, demand levels or order blocks are the last down candle before the up move. And demand levels are zones that have a significant volume, right? And they have a high concentration of institutional short orders. And these could be short orders, hundreds of millions of dollars worth. And these large size short orders were accumulated or they were executed to manipulate liquidity levels, such as support levels or equal lows, to take out the stops of those retail traders, right? And when price falls to test these demand zones, what the institutions will do is sell as much of their short positions as they can to the buyers. Because, guys, remember, they have hundreds of millions of dollars worth of short positions. They can't simply sell it all at once. For every position, they have to find a buyer, right? And they look to find those buyers once price retests down towards our demand zone. And so this causes prices to rise at our demand zones as all of the available supply or all of those institutional short orders in those demand zones at this price level has been absorbed or bought by the buyers, right? And so what we do is look to long the market of the open of this candle and put our stop losses just below the wick. Now, what is a supply zone? Now, supply levels or order blocks are the last up candle before the down move. Now, supply levels are zones that have a significant volume, right? And a high concentration of institutional long orders. This is the opposite of our demand zone, which was a lot of institutional short orders. But now a supply zone is a candle, right? It's a bullish candle that has a large accumulation of institutional long positions, right? And these large sized long positions were accumulated to manipulate liquidity levels. So this candle was used to take out the stops of equal highs or resistance levels, which are also referred to as liquidity levels, right? Because we have a lot of stop losses at this level, right? So this candle was used to take out those stop losses. Now, as price rises towards the supply level, there is a far greater amount of sellers who are willing to sell their short positions, right? Because when price rises, these sellers are much more attracted to selling their short positions as they gain a higher profit. But even fewer buyers who are willing to buy their short positions as prices are too high for them. Because, guys, remember, when prices rise, the supply increases as the sellers, they can gain a higher profit by selling their positions at higher prices, but demand declines as prices have become much higher. So we have a lot of sellers who are willing to sell their short positions because prices are much higher, but even fewer buyers who are willing to buy their short positions as prices are too high for them. So when prices rises, where do you think the sellers are going to find those buyers who want to buy their short positions? They find those buyers at our supply levels because, guys, we have a lot of long positions accumulating at this supply zone. These are institutional long positions at the supply zone. And the sellers, what they will do is they will sell their short positions to these buyers, these institutional buy positions that are at this supply zone, as again, the institutions, they want to exit their long positions. And the only way they can exit their long positions is through exchanging their long positions, their billions of dollars worth of long positions, for short positions. Therefore, The sellers, what they will do is they will absorb or sell as much of their positions to all the buyers. And again, all the buyers are available at the supply zone because we have institutional buy positions at the supply zone who are available to buy their short positions as prices increase towards our supply zone. And this causes prices to fall drastically from our supply level as a large concentration of the buy orders which were available in this bullish order block have been exchanged for short positions. Guys, what is the criteria to identify a valid demand and supply level? So the first is engulfing or imbalance. So after the creation of the order block or the demand or supply, imbalances must take place. This is because the imbalance shows that the auction has completed, the institutions have basically exchanged and exited some of their positions at the demand or supply level, and this results in a strong market reaction to the opposite side. As well as this, guys, the imbalance is seen as an inefficient price movement, right? It's unfair value as the market did not spend much time here. So basically, there was no fair exchange between buyers and sellers at price levels where imbalances occurred. So eventually, price acts as a magnet towards the imbalance, right? So price is attracted to filling that imbalance. So we want to see price come down to filling that imbalance. And also, guys, what we want to see is a bullish imbalance created after a demand zone. And the bullish imbalance, it suggests that we have excess demand, where we have more demand than there is supply. And we want to see bearish imbalances created after our supply zone. As the bearish imbalance, what does it suggest? It suggests that we have excess supply, where we have more supply than there is demand. The second is, and I think this is one of the most important requirements, is that the order block needs to take out liquidity. So the order block or the demand or supply must take out liquidity zones. Now, liquidity zones, as I said, are saturated with retail positions and retail stop losses. Now, liquidity zones are zones such as trendline support levels and equal lows, and they need to be taken out or liquidated by a demand zone. And this demand zone, what it will do is take out the stop losses of those buyers who are buying on those trendline support levels and equal lows. And then the second thing is we want to see liquidity levels such as trendline resistance levels and equal highs. They have to be taken out by a supply zone. And again, the supply zone, its role is to take out the stop losses of those retail sell orders who are selling on these trendline resistance levels and equal highs. Now, what do I mean by this? So in the first example, we have examples of our supply zones taking out liquidity levels. So the institutions, they know that a large majority of retail orders are accumulating, or retail sell positions are accumulating at the equal highs or at our trendline resistance levels. So what the institutions will do is they will execute hundreds of millions of dollars worth of buy positions to take out these stop losses, and then after we want to see large selling imbalances created afterwards. Now in our demand zone, it's completely the opposite concept, where we have a large concentration of retail buy positions accumulating at our equal lows and are accumulating at our trend line support levels, and the institutions are able to see that there is a lot of buy position stop losses lying below this level. So what they will do is they will execute hundreds of millions of dollars worth of sell positions to take out those buy stop losses, and then what we want to see is imbalances or bullish imbalances created afterwards. The third criteria we want to see is the demand and supply levels lying in areas of premium and discounted pricing. Now, guys, if you haven't watched my last video on premium and discounted pricing, I recommend you'd watch it, as I really go in detail about what I mean by premium and discounted pricing and how we can use the volume profile tool to identify our premium, our discounted, and our equilibrium levels. So, why is this important? So identifying premium and discounted areas provides us with the highest probability supply and demand zones. Now, premium and discounted pricing zones represent which demand and supply levels are deemed to be too expensive or too cheap. Now, we identify the equilibrium as the point of control with our volume profile tool. as I said in the last video, and the supply levels above the equilibrium are the highest probability supply zones, as price levels above the equilibrium attract a lot more sellers to sell their short positions as they gain a greater profit, right? And this causes prices to fall, and the demand levels below the equilibrium are the highest probability demand zones, as prices below the equilibrium attract a lot more buyers to buy the market as they gain greater profit by buying cheaply. And this causes prices to rise as we have that excess demand. We have greater demand than there is supply. We have a lot more buyers who want to buy cheaply and even fewer sellers who want to sell their short positions as the prices are too low. So let's have a look at some examples. So in the first example of a supply zone, what we do is we use our volume profile tool and drag it from our lower high to our lower low in our downtrending market. And the POC, which shows the most traded price level within that swing, is our equilibrium level. Now, the most powerful supply levels lie below our POC or our equilibrium. And as you can see, the market reacted nicely. Now, another example is again dragging it from our lower high to our lower low, and anything above or any supply levels above our point of control becomes our powerful supply zones that we want to enter off. And we want to avoid entering of supply zones that lie below the point of control. Now, in our demand zones examples, what we do is we use the volume profile tool and drag the tool from our higher low to a higher high, and we want to be entering off demand zones that are below the equilibrium level in discounted pricing. Now, finally, the fourth criteria we want to see is the availability of inducement. This is very important, I believe, and it has to be there. So inducement is the creation of liquidity that lies just before the demand or supply zone, right? And the inducement must be available to validate an order block, as when prices either go up or down to test our demand or supply level, the institutions, remember what I said, they must exchange their hundreds of millions of dollars worth of positions to exit their trades for opposing positions who are available. And when we have liquidity zones nearby, we have those positions who are willing to exchange their positions for the positions of the institutions, right? And so, without the inducement zone, institutions are not able to get rid of their large positions as they have no one to sell it to. Remember, we said that the institutions, they have hundreds of millions of dollars worth of positions that they're trying to get rid of. And the only way they can get rid of it is by exchanging it for opposing orders. For example, if they have buy orders they're trying to get rid of, they have to sell it to short positions. And those short positions are available when we have inducement nearby our demand or supply levels, right? And this causes the order blocks without any inducements to be low quality, and we generally want to be avoiding those types of order blocks. Now, here are some examples of our inducement. So in the first scenario, in our supply zone examples, we want to see the inducement or the liquidity created just below the supply zone, right? This is what we call inducement. And in the second example, for our demand zones, we want to see the liquidity created just above our demand zone, right? And this creates the highest probability demand zone, right? Because this inducement, it needs to get taken out, and then price needs to mitigate, or it needs to hit our demand and supply level. Right, guys, let's have a look at some examples. So right now I'm on pound yen, and I have identified a powerful supply zone. Why is this over here a powerful supply zone? Because it follows all of our four criteria. Number one, it took out this liquidity level, this equal high, right? Number two, it led to huge selling imbalances after the creation of our supply zone. Number three, we had that inducement, right? We had that liquidity created just before our supply zone, right? These are equal highs that are created just before our supply zone. And number four, if you use the volume profile tool, what you want to do is you want to drag your volume profile tool from the lower high towards our lower low, and this gives us our equilibrium level, right? And anything above the point of control, which is our equilibrium level, so all of this area over here is our premium pricing. And we know that we find the most powerful supply zones in our premium pricing zone. So without a coincidence, this supply zone was above the point of control, which is in our premium pricing zone. So once price came to the open of our supply zone, we can see nice selling price action taking place, right? So let's have a look at another example. So another example would be this supply zone. So if you go on the 4 hour, it looks much more clearer, right? Over here, right? This is a nice supply zone over here. Why? Again, number one, it took out liquidity, right? It took out these equal highs over here. It took out liquidity. Number two, let's go back to the 1 hour. Number two is that it led to imbalances. It led to imbalances after. It led to all this selling imbalances afterwards. Number three, we had this inducement over here, right? We had these equal highs that are created just before our supply zone. We can see these are equal highs, right? And number four, it lies in our premium zone. Now, if you drag your volume profile tool from the lower high of this range to the lower low, we can see that the supply zone aligns just next to our point of control, which is just in our premium zone. So without a surprise, the market, what it came to do, it came to mitigate, or it came to hit the supply level, right? Take out this inducement, take out this liquidity, then the market sold off. Now what you could have done is, because this is a higher time frame supply zone, what you could have done is wait for a lower time frame change of character to enter and increase your risk reward ratios. Guys, here's another powerful example of a powerful demand zone on GBP NZD. So I'm having a look at this demand zone. Why do I think this is a powerful demand zone? Again, it follows our four criteria. Number one, it took out these equal lows, right? It took out this liquidity level. Number two, it led to bullish imbalances afterwards, right? It led to these bullish imbalances afterwards. Number three, it created inducement. There was inducement that was created, or liquidity levels or equal lows that were created just above our demand zone over here. And number four, it lies in premium pricing. And again, to identify your premium, your discounted and your equilibrium price levels, you have to identify the swings. So here's our higher low, a higher high, our higher low, and then so on. So what we do is we use our volume profile tool and we drag the volume profile tool from our higher low to our higher high. Now again, where is your premium? Where is your discounted pricing? Because again, we find the most powerful demand levels in our discounted pricing zones. Our discounted pricing zone is below the point of control. So it's below, so it's all this area below the POC. This is our discounted pricing. And without a coincidence, the point of control, it lies with the open of our demand level, right? Here's the open of our demand level, which is also the level of our point of control. And then as you can see, the market, it reacted nicely off this demand level. And again, guys, when identifying your demand and supply levels, although they may follow the four criteria, what's most important is it follows the bias of the trend, right? So if we are in an uptrending market, you can't counter trend and find the supply zone and say, okay, this is a powerful supply zone because it follows the four criteria, right? Although it follows those four criteria, you have to always keep an eye on the trend. For instance, this is a powerful supply zone over here, right? Why did this supply zone fail though? Why did it fail? It failed because we are in an uptrending market, right? Have a look, we are in an uptrending market. This supply zone may be in a premium pricing zone. It may created imbalances afterwards. It may have taken out liquidity. However, we are in an uptrending market, which is why you should always follow the trend in your analysis. Guys, I hope you understand how we can use those four criteria in order to identify the most powerful demand and supply levels. And again, guys, if you need any help, feel free to message me on my Instagram. And yeah, I'll see you guys in the next video.